Good morning. Today is the end of the month podcast video, day 2. So we're rolling over derivative contracts that have June quarter 2 expirations to September quarter 3 expirations. Yesterday we bought back our June contracts and sold at a higher premium the September future contracts, although we did make money. Now, today we're going to do the options. And I like the options. It's a little more social. I'm going to deal with a market maker today. It's also interesting because in some senses, this guy could be considered our competitor. But like derivative markets, I can sell a contract for my own reasons that I'm completely happy with. And he can buy one, an option in this case, as a market maker that he's completely happy with. And he knows how to hedge the risk for it.
Okay, so this is exciting. It's a foundation of my first institutional trade, even though these are tiny amounts of money.
So are you rolling your options right now? Is that what you're saying?
Yeah, you're going to benefit as a market maker from this, and I'm going to benefit because I'm completely happy with the terms and probabilities associated with the contract, right?
So, yeah, no, it's great. Yeah, options is not a zero-sum game, actually.
No, both parties benefit.
Yeah, both parties can absolutely make money. It depends how you trade it, how you hedge the gamma. If you trade it hedged or unhedged, you know, it can be win-win. It can also be lose-lose, I would like to say.
Yeah, but I mean, well, so maybe give me some veteran advice. And we got a 46 or 47% realized volatility over the last year for Bitcoin. Does it sound like about your numbers or what you were seeing?
Yeah, bang on. Yeah, very close.
I'm earning Bitcoin at a rate of like 0.25, so like 11 or 12% per year, or I'm earning dollars. So you're looking at a 34% dollar gain. So like on a quarterly basis, am I having either outcome? So what's the draw for both parties? Maybe you want to explain it here.
Yeah, I mean, for something like this, obviously, then the draw for me is that I own convexity, right? So in the event that Bitcoin goes higher and let's say breaks through new highs, I make money because spot's higher, but I also make money probably because the volatility is higher as well. So it's a double whammy. And I also own the tail risk, right? If this really goes exponential and we're talking about goes to, 110, 120,000, the payoff is convex. I make more and more money as this stuff goes. And so owning this, is kind of like insurance on Bitcoin going higher. And so it's an attractive opportunity because what I can do is from day one also hedge it initially and I sell the amount of Bitcoin that I need to. And so I can make money if it goes lower as well. So even though I'm buying a call, I can make money on both sides of spot.
And tell just for beginners who I'm always on the taker side of the equation. Can you explain how you also profit if it goes lower? Like, do you do this through derivative contracts or do you do it through like an actual spot transaction? Please explain how part works.
Yeah. So if you trade an option on any sort of asset, there's a time component, and it's not an option. Understood here. It's not an option on the spot asset. It's an option on the declining maturity forward, right? So in Bitcoin, as spot goes higher, implied rates go higher, so the curve gets more and more into contango. So the back end of the curve moves more, and so you actually own an option on something that's quite a bit more volatile than the spot asset itself. And so the way you can do this, you hedge by trading that future, so that as things kind of decompress and as things tighten, and let's say this contango comes down to par, you make money on that itself, right? And as spot goes lower, you make money on the hedge, and the option premium goes to zero. You can make money on both sides here. You just need something to move, right? And that's the expression of volatility. You need volatility to make money here.
As it turns out, I'm in trouble with the block order, so I just did it manually. But here's the option I decided on. September 27th for $85,000. The option premium is 0.0255%, which is 11% per annum in Bitcoin. So if I sell that and it expires worthless, then I'm making 11%. If it goes up to 85,000 and I get called, I'll still have made 34% in the quarter, 231% return on my money on an annualized basis, which you can hardly complain about.
So anyway, interesting day on three levels. Number one, we got to talk a little bit about what the guy on the other side of the trade is seeing. Number two, you can see the market's a good market because like both parties benefit. I was totally happy with the contract I sold. He was totally happy with the contract he bought. And then finally, just along the cooperation level, we had a conversation afterwards, and Jeff was kind of interested in our butterfly program. We might cooperate on that level later. So I love the derivative market. There's definitely a lot of interesting trades to be made, and more on this all later.